Welcome, everybody. Thank you for your little bit of patience as we're unlocking the waiting room. Welcome to the second part of our series about insurance during kind of the growth phase of your company. My name is Ryan Nash. I'm the COO of Gust, and I am joined by Chris and Allie today from Vouch. They were with us just last week when we talked about insurance for a growing company, and that was all around team expansion. You know, if you've raised a small seed round or a friends and family round, or you're bootstrapping your way, you're going to probably use most of that money to hire a team and salaries. So check our YouTube channel. We've recorded that. We had a lot of great questions, a lot of great engagement for that one. Today's theme is protecting yourself when launching your product. So depending on the path your startup might have went, you might have market validated, you might have MVP'd, but at some point you're going to put something in the market in a public way, and that comes with some additional risks associated with it. So we're going to focus today, again, with Allie and Chris, all around the various kinds of things to think about. And the gist of it is this is not like one size fits all. You should always just X pay more money. It is like specific on your company, specific on your industry. You can really find a way to optimize, you know, both how much you're spending and how much protection you need. I'm going to hand this off to Allie, but like we'll get asked many times throughout this. Yes, we're recording this. We will send a recording out a couple days afterwards. We'll also upload it to our YouTube channel. If you just subscribe to that, you'll get the easiest notice in the world from that. And then you'll also get a follow-on email from me. And also be on the lookout for the third part of this, which the invites will be going to actually probably as we're here or shortly after it. Please use the Q&A for questions. We will have time for questions at the end. You can also throw in, you know, your startup name and your location in the chat as we kind of warm things up. But without anything else, Allie, please take us away.
Thanks, Ryan. We're so excited to be back. We were just here last week, but excited to be talking about a totally different milestone today. Launching products and having customers, crucial to hopefully everybody's business on the phone today, and a lot of fun things to kind of dive into. So before we get started, just some quick introductions. My name is Allie Schneider. I lead the partnerships team here at Vouch. We are a high growth startup ourselves, and we do business insurance specifically for VC-backed technology companies. So we spend a lot of time helping founders think through their risk exposures, risk management tactics, and how to think through the right insurance programs for their business. So hopefully we're qualified to be the experts on the phone for you today as we kind of walk through some of the things that'll hopefully be really helpful for you all to keep in mind as your businesses are growing and scaling. So that's me. I'll hand it over to Chris, and then we'll get into it.
Yeah, thanks so much, Allie. So my name's Chris. I am one of the licensed insurance advisors here at Vouch, just one member of a team with decades of insurance experience behind us. So we're really excited to have you all here today, and hopefully you walk away from this webinar with a little more knowledge about insurance in general.
Awesome. I'm going to share my screen. Let's see. All right. Chris, can you give me a thumbs up? Are we good?
All
Perfect. So one thing that I will say, these sessions are so much more fun the more questions that we get in the chat. We want to make sure that we're using the time as well as we can and to make it as valuable as possible for everyone here. So please, you know, put comments in the chat, put questions in the Q&A section as well. And, you know, as it makes sense to answer those throughout, we'll answer some as we go through, and then we'll have time at the end for questions as well. So without further ado, let's get into it. So for some of you that joined the first session that we did last week, bear with me. We're just going to do a kind of quick recap on why we're here in the first place and why risk management is important. But at the end of the day, like starting a company is inherently a risky thing to do, right? And kudos to you all for doing that. You know, we know that, you know, companies, you know, have challenges for a multitude of reasons, right? Legal challenges, people challenges, funding challenges. Today, we're really going to focus on the challenges that come along with having customers and having people using your products and services. Again, incredibly imperative to kind of growing and scaling your business. And as founders, it's one of your most critical jobs to de-risk your business, right? We try to avoid being a scare tactics shop over here. But the reality is that bad things do happen to good startups. We see it all the time here at Vouch in terms of the claims that come in and how we work with our customers. And so the first question really is, you know, how do you think about risk and how do you manage risk? And this is a really simple framework, but we find it can be really effective in helping our clients actually think through, how do you de-risk your business in the first place? And so it's really all about understanding or thinking through, right? What is the frequency of a certain risk happening? What are the chances of it happening? And if it does happen, what's the severity, right? So, spilling a LaCroix on your laptop, not ideal, right? To have to replace the laptop, but that's something that's maybe pretty low severity loss, maybe high frequency, depending on how clumsy you are, right? That's going to be a really different risk exposure than, having a cyber breach, which we're going to talk about today, because you have all this sensitive customer data that has somehow been hacked, right? That's maybe a little bit lower frequency, but very high severity. And so when you think about the tactics that you have to actually manage risk, you could always accept certain risks and say, I'm okay with these things happening. I'm going to take my chances. You could say, I'm not okay with something happening. I'm going to go out of my way to avoid a risk at all costs. But those are two extremes often, right? And so, when you think about kind of those middle cases, how do you mitigate risks, right? What are the things that you can do to decrease the chances of that risk happening in the first place? That's another tactic. And then the last tactic is transferring risk to a third party. And that's essentially what business insurance is at the end of the day. So one of the things that we do actually here at Vouch as a high growth company ourselves is we run a quarterly risk registrar process with our team and company to really go through and identify, what are the things that keep us up at night? What are the biggest risks to our business specifically? How do we prioritize those, right? In terms of how likely and severe they are? What are the actions that we're going to take? And then do we monitor, right? Are we monitoring things on a regular basis and making sure we're keeping track of how things are progressing overall? So before we get into the specifics, I want to do a quick legal disclaimer, right? Insurance is one of those things that is rarely cut and dry. It's very different. Each person's needs, company's needs, programs are very, very different. So we'll do our best to kind of speak generally today. We're always happy to have one-on-one conversations with folks as it's helpful to talk about your individual use cases, scenarios, business operations, et cetera.
I do want to add the anecdote that we went 5 years without a single laptop spill at Gust when we had our own office, and then there was 4 in one quarter. Just as a random how life works.
Brutal. They're especially laptops today are very expensive, so it's important. Cool. So let's get into the fun stuff why we're here today. And really what we're going to do is talk about the transfer option of risk management, right? Business insurance through the lens of acquiring your first customers, right? So as a business, you're going to go through all of these key milestones, likely at some point or another. And there are different risk exposures that come up as you're going through these milestones. So the one we're going to focus on today is launching products. So whether you're a B2B company, a B2C company, B2B2C, what have you, when you're launching new products and you have users that are using your products, it opens up a whole kind of new arena of risk exposures and things that you really need to be thinking about, and things that could potentially go wrong that you need to prepare for. And so what we're going to talk about are the risk exposures and mitigation topics that come along with acquiring your first customers. What are the common claim scenarios? And then go through the coverages that will be really important to have a deep understanding of. And I think one of the things that's really interesting to keep in mind is, yes, all of these coverages are ones that proactively you should definitely want to have in place, just to be as prepared as humanly possible. But I think it's also important to note that a lot of these coverages are going to be required by partners that you work with. So if you're a B2B company, you are for sure going to have cyber and E&O requirements from the enterprises that you serve. If you are a B2C company, you're definitely going to have product liability requirements from partners or third parties or wholesalers that you work with. And one of the things that I think is really important to keep in mind is these requirements can often be really high. And what a lot of our customers don't always realize is sometimes you do have some negotiation leverage with these coverages. So a great example, prior to joining Vouch, I was actually at E-Trade. And for any service provider, startup, et cetera, that we worked with, we required $5 million worth of cyber and E&O coverage. That can get very expensive very, very quickly for a pre-seed or seed stage company that's trying to kind of secure their first, Fortune 500 client. And so one of the things that's important to keep in mind is your cost of customer acquisition, right? Do you want to spend, $20,000 on insurance to acquire a customer where it's a free pilot, right? And so often what we'll do with our customers is work with them to understand, what are the coverages that make sense based on where the business is and what their needs are. And sometimes you can actually you can negotiate the kind of limits or the requirements that your customers are asking for. So we'll get into that a little bit more here in a second, but I think it's important to just keep in mind, again, like what coverages are going to be required, and then how you can think about negotiating some of those at points as well. Cool. So if we think about it, let's just first kind of get in the mind frame of how we get customers on board and thinking about risk framework and how it applies as a B2B SaaS company to start, right? So if we kind of apply our different tactics, you can't not operate your business digitally, right? But there are a lot of things that you can do from a mitigation perspective to reduce the chances of, say, a cyber risk occurring. And Chris is going to get into some of these examples here. You can transfer the risk through business insurance, or you can accept it and hope that nothing bad happens. So again, it's important to keep in mind that you do have different tactics, and you just have to figure out what makes the most sense for your business. Chris, you want to elaborate a little bit on some of the specific risk exposures here?
Sure, absolutely. Thanks so much, Allie. So kind of getting back into something that Allie alluded to earlier with that proactive versus like reactive mentality when it comes to insurance. So as you're launching a new product, growing your services, there's going to be a few different things that are going to pop up for you. So one being compliance risk is a huge factor there that certainly kind of want to keep on top of your mind there. So another being maybe no payment solution, or you're using a third party for that payment solution. Maybe there's some third party code risks. You're using engineering contractors potentially there. You may be engaged with a law firm already that might not necessarily specialize in startups even. They might not really be familiar with the risks that you're facing on the early stage side of things if they're more familiar with those higher growth, larger companies. And then, as Allie also mentioned, sometimes there are inadequate standards or agreements within contracts that we see come through quite a bit, actually. It's not untypical for a larger company to kind of have a boilerplate set of agreements that they send out to just anybody that they're trying to sign up, that they're trying to work with. So being aware of the coverages that you actually need, the coverage limits that are appropriate for your business and your current stage is really important there as well to kind of renegotiate those contractual requirements or standard agreements. Oftentimes, you're also running into a lot of intellectual property risks. There's trademark risks that come with that as well. And then at some point, as your company grows, also a good amount of equity distribution risks. Say you're bringing on additional board members, maybe some advisors, even additional executives. It can get a little dicey sometimes. So these are all things to consider, especially when you're launching a new product or services with your startup. Good to go to the next one. Thank you. So there's certainly a few different risk mitigation tactics that people can do. So we've already touched on some of them. Avoid, reduce, transfer, or just accept the risk in general. Here at Vouch, we do provide a few additional perks for our clients. For instance, SOC 2 compliance. So Vanta really simplifies the complex, time-consuming, and tedious process of preparing for a SOC 2 audit. So they cut prep time by 2 to 6 months, and then we're also providing an additional incentive, so 25% off your annual cost if you are a Vouch client than using Vanta. Other helpful resources are out there too that are free. Another compliance platform like ThoroughPass, for instance, provides complete compliance solution, expert guidance, consultation, representation, and audit services through an ecosystem of partnerships in their own framework. So there are those people out there who are willing to help you offload that list, offload those additional risks along with your insurance provider. So good to kind of keep them in mind, have those in your corner as well there as you progress and get closer to product launch or into that product launch in general.
Can I ask you guys a question?
Yeah.
This is an interesting element I don't think we brought up last time, but do you guys approach clients sometimes where it's like, you know, they're at a particular risk threshold, say they need SOC 2 or something like that? Is the relationship like, hey, well, you could get covered at this massive amount if you just transfer the risk to us, or if you go and work with this, you can like significantly reduce the cost of this because you will have, you know, compliance? Is that kind of what you're saying there with it's like a joint mitigation tactic?
Basically, Ryan, yeah. So what we do see, especially, I'll call out Vanta here since we do have them on the slide. What they'll typically do is send us clients after they are kind of in the process of going through this SOC 2 compliance process or right afterwards in order to obtain their cyber insurance coverage. So it actually at some point becomes a requirement for most of these customers and does initially like help them with their premium too, help them reduce their premium a little bit if they're already in compliance, having gone through these kind of programs.
Cool.
Yeah,
Awesome.
especially if someone has gone through SOC 2 compliance. I mean, whether you officially go through the certification or not, it requires you to think through like, what are all the right protocols that you essentially need to have for your business? How do you want to think about the right security protocols, team member protocols, two-factor authentication, et cetera, across the board? And so one of the things that we look at from an insurance perspective, to Chris's point, is the more that someone has done to mitigate their risk exposures, the more that we can incorporate that, proactivity into their premiums for what they're actually paying for from an insurance perspective.
Yeah. And kind of does flow both ways at a certain point too. If we do see certain exposures popping up, or hey, our underwriters find some red flags, there may be some gaps in your software. We're also happy to refer clients to these other third-party companies that can kind of help them maybe reduce those gaps in compliance or mitigate, kind of remediate their software a little bit too. So it goes both ways.
Well, we had a question in the Q&A, which will just help. We keep saying it, SOC 2. And wow, off the top of my head, I cannot actually remember what it stands for, but it's SOC 2. It is a industry standard threshold for cybersecurity that a lot of once you get into a B2B arena or you get big enough, partners will demand that you have. So there's SOC 1, which you can kind of get on your own and you get some things. And then SOC 2 is like you get audited. It's a many months long process to really get your organization equipped to handle it. But usually, especially in the B2B SaaS arena, to get big clients, they're going to demand it. It's similar to like payment processing coverage or handling, personally identifiable information, but just on the technology side.
Yeah, exactly. Basically just how you guys should be managing your customer data at a certain point there.
Yeah. And JP, to your question, we're going to get exactly into the coverages as we speak. So that's a perfect segue.
Yeah, absolutely, guys.
There we go. You couldn't have teed that up better.
Here we go. So we're going to get into the coverages here. First on the list being our business owner's policy, and then the commercial package policy. So really, we think of the business owner's policy and the commercial package policy as like a foundational coverage. So it includes general liability and business property coverage typically. And with regard to general liability coverage, this is designed to protect your business from claims related to property damage or physical injury occurring either at your business or by your product. So it's a really standard kind of legacy, more traditional kind of coverage there. And then when we say business property, think of physical property that your business owns. Most times nowadays, especially with these tech-oriented companies, think of that as even like employee furnished laptops. If you're purchasing laptops, furnishing those to your employees, instances like that, it's designed to cover the cost to replace the property if it's damaged in a fire, maybe your office is robbed, instances like that. Again, getting into contractual requirements, this is typically a contractual requirement, even if you're leasing office space or not there, kind of comes along with those boilerplate contractual requirements that these larger companies are throwing out there. So it is especially relevant if you're renting office space or furnishing employees with employee-owned and company-owned laptops. But again, you're going to kind of see it pop up a lot more. And we'll get into this a little bit later in the slides. But thankfully, one of the less expensive coverages typically that you have to secure. Get to this one. So kind of getting into some claims that arise here. So kind of just throwing this out here, first being a bodily injury or a product liability claim even here. So incident, there's a pre-revenue Vouch insured. They have a surgical robotics platform for a notable hospital. So this has probably already been required by that contract with that hospital. So they're using it for a medical student demonstration. And after the demonstration, someone's going to report a bodily injury claim. They're complaining of blurred vision, nausea, etc., from the use of that product. Good news is they already have this coverage in place. So the Vouch insured indicated that the lasers responsible for the bodily injury claim were proprietary technology of another company. And even though they don't have commercialized product, there is still exposure for bodily injury and court costs, both of which are covered under the product liability policy, which is a sublimit, a portion of this business owner's policy, the commercial policy package here. And then again, getting into damage to rented space. I always kind of like to throw out the example of, hey, you're celebrating a launch, you're having a launch party. Maybe somebody has a little bit too much champagne, there's a trip and fall situation there. Even an instance like that could be covered under this kind of policy. Or maybe you're a little too celebratory. There's some wall cracks. Maybe you're cracking some furniture frames in the leased office space as well. This is designed to kind of come up and cover those costs of repair as well there. Fantastic. So kind of getting into the pricing here, there's going to be some key exposure features that our underwriters consider when pricing the general liability and the business property side of things. So the cost of general liability insurance is typically based on the size of your business, the type of industry you're in, and then the level of risk associated with your business operations. So business operations factors such as the type of products and services you provide, the number of employees you have, and then your business location all kind of helped us to determine your level of risk and appropriately price your policy there. So at the end of the day, also the amount of coverage that you choose is going to have an impact on your premium. Think of it as more coverage, typically more premium in a lot of instances. When it comes down to business property, it's typically based on the value of the property you want to insure. So if it's just company-owned laptops that you're furnishing to employees, maybe less expensive than if you're actually manufacturing a lot of products, going kind of back to that robotic arm example. Something like that may be a little more pricey, priced a little bit higher, depending on the type of property, the risk factors that you're trying to insure there. Again, does also get down to location and then the age, condition of the property and your operations exactly. Fantastic. So there are some key trends that we're seeing in the industry, specifically impacting these business owner policies and commercial policy packages here. So on the general liability side of things, we are seeing a growing concern about social inflation. And when I say that, it kind of refers to the trend of rising injury verdicts and settlements. So it's typically leading to higher claim costs and also increased premiums for that general liability insurance there. And then we get into the business property side of things. We're seeing changes on different sides. So one of them being like climate change and extreme weather events, for instance. So again, depending on location, maybe you're located in Florida, maybe a little more difficult or a little more expensive even to secure this general liability, especially the business property side of things, just depending on the weather events that you may kind of face there. And then we are adjusting our rates to coverage options to kind of reflect these risks. Another one being COVID-19 really demonstrated like the importance of business interruption, which is also typically a sublimit coverage for these commercial policy package and business owner policies as well. And then as I'm sure a lot of you are familiar with, there is a dispersed workforce kind of factor here as well. So especially here at Vouch, we have like a work from anywhere endorsement or a permanently away business property that's permanently away from a specified location within the policy. So even if your employees are dispersed, remote first kind of companies, there are coverages in place in the industry that are designed to kind of protect the business property while it's in possession away from the listed address on that policy.
And then, Chris, before we move on, we have a couple of
Please.
questions in the chat that I think are relevant for product liability. So Elias asks, can you provide guidance as to the types of insurance that would be recommended for a B2C VR gaming company? So I do think when we get into cyber and E&O, some of those coverages will make sense as well. But one thing that I think is important to note on the VR side, like if you're providing the headset, right, for folks, let's say, you know, there's a hardware component to it, that's where a coverage like product liability is so important. Let's say someone's using the headset, right, or a physical piece of hardware that you provided to them and they injure themselves or something happens, right? That's where a coverage like product liability is really, really important. I think Dogan had an interesting question too. You know, if we're selling a product that's open to modification from the buyer, do I still need product liability related coverage because it's a kit and my customer makes edits? That's a really interesting question. I don't know, this might warrant a kind of offline discussion, but Chris, I don't know if you have any thoughts on that initially off the top of your head.
Yeah, no, I see the question there, Allie. I think, I mean, my recommendation would still be the product liability side of things there. If you're actually manufacturing a tangible like physical product and supplying it to customers, there's always that risk that even if the product is open to modification, that they kind of loop you into a lawsuit still too. Because I mean, at the end of the day, even if they're able to modify it, it is still your product that you're producing there. So I think the risk exposure is still there and product liability would be pretty relevant, but happy to kind of take that one offline too and then touch on it further. And then one of these coverage risks of transfer mechanisms. Yes,
Oh,
so going to get into that too for the pilot and the growth phases. So we'll touch on that in a moment here.
And anybody in the audience, for those specific kind of questions, stay tuned for emails from me. I think moving into probably into the summer, because we have been talking about doing programming with Vouch about specific verticals. So this one is very much like, what everybody should know about insurance as your company grows, but there's also some really cool stuff like a CPG company, which is consumer packaged goods, or, a made to modify, or, hard tech startups versus fintech startups. We haven't gotten the themes yet or the events planned, but there'll be some cool ones that I think will be relevant to different segments of our community, not just the general education part.
Exactly.
Let us know what you want.
Yeah, actually, maybe I'll throw a survey in the follow up on this one just to get a little bit of info there.
Awesome.
Exactly.
Cool.
Great.
And then Chris, maybe we just round out on the BOP front, and then we can move on to cyber.
Yeah, we'll make this short and sweet. So you're typically going to see this with like new lease requirements, getting into a new office space. It is usually, again, even if you're not in an office space, a contractual requirement that gets thrown out a lot. Depending on your overall exposure, if you are getting into a new office lease, even acquiring a building, instances like that, it becomes very relevant at that point too, again, because of the property damage, the third liability, bodily injury exposures there. And then legal and regulatory requirements, kind of digging into like that product liability side of things. If you're actually engaged in manufacturing, other instances like that where you're supplying a physical product, it does typically become like a legal or regulatory requirement as well there. So kind of rounds out the business owners and the commercial policy package. Great, guys. So getting into the cyber coverage now, really just threats and data breaches are on the rise and can result in really significant financial risk. So that's where this cyber liability insurance can help protect your company's reputation and then also kind of give your customers peace of mind. So it's really designed to protect your business from instances like data breaches, cyber attacks, ransomware, and then other types of digital crimes here. So it provides coverage for the costs related to those instances, and then typically includes costs for legal fees, data recovery costs, and then business interruption costs as well there, and notification expenses. Say you have to send out a mass email to people, or you have to implement credit monitoring expenses as well. Instances like that designed to be picked up by the cyber coverage here. I like to think of this first party coverage as being for your system. So designed to pay for costs of notifying those clients, getting that forensic investigation in there, any software remediation you have to do on the back end, and then even credit monitoring, again, if you had to implement that service because of a data breach. And then the third party coverage. So let's say it's an unfortunate event where you get wrapped into a lawsuit. This is designed to pay for those legal fees, settlements, judgments, fines that you may incur. And then ultimately, it's an important tool for business of all sizes. I typically recommend it if you have a product in market, or if you have a really big audience for your beta testing there, it could be relevant as well. It's just, they continue to increase in size and frequency and complexity. So this is really important if you're providing any sort of like software service component to your business. And then we kind of jump in here to some certain claims that arise. So we're thinking on the first one of a breach of software testing tools. So startups providing the testing tools experience in a breach, they get some hackers in there. Good news is they had a cyber policy in place already. So this is going to cover the cost of the computer forensic investigation, also that public relations advice if they needed to implement that, and then claims by customers for the cost to conduct their own forensic investigation. So you can kind of see how there's multiple layers to the cyber coverage, which makes it really necessary for any software company. The second one, getting into AI gaming. Say a hacker is able to gain access to the systems of the startup providing an AI-enabled text adventure gaming service. So they're going to get some user content, some of the users' adventures, scenarios, things like that. This is where that cyber policy is going to provide coverage for the computer forensic firm to investigate the breach, also fix the issue, and then also the cost of notifying any relevant parties, pursuant in this instance to like the EU's general data protection regulations. So really helpful in a regulatory stance as well here.
And really good question from Elias as well. Chris, does the cyber coverage also cover for third-party services that one's using, whether it's Azure, AWS, et cetera, or do they have their own insurance?
It's a great question, and it's kind of two-sided there, Elias. So we do typically, I mean, Azure, AWS, et cetera, kind of have their own policies, I'm sure, very large, very expensive policies in place there. However, it's not untypical. It's pretty typical for them, if their system is breached because of your system being breached, to wrap you into a lawsuit. So it is designed to react in a situation where the data breach that your company is affected by, if that then kind of transfers and affects a third party's system as well, designed to pick up those costs for the software remediation. And then if there's any legal fees, judgments, or fines that you incur because of your breach spreading to another person's system. Awesome. So kind of getting into pricing, again, just a high variance in pricing, depending on the size of your business, the stage, the number of active users, also the type of PII, so that personal identifiable information, that sensitive information, if you're collecting it and storing it. And then it kind of gets into if you're storing that on your own system, or if you are offloading that to a third-party storage system there. So all kind of factor into the level of risk associated with your specific cyber threats, and then ultimately does impact your cyber premium there. Things like implementing two-factor authentication, like Ali mentioned earlier, or being SOC 2 compliant, putting up firewalls, maybe using data encryption. Those are all good risk mitigation measures you can take to potentially reduce your cyber premium and then better protect your company in general. It is typical for an insurer, like we kind of mentioned before, to run a few tests to evaluate your business's cybersecurity practices and risk management protocols when determining your premium. So having those risk mitigation factors already in place, or having a really great kind of sense of where you are at in this and the building process helps a lot too. Cyber liability ultimately is a relatively new type of insurance too, so it can vary widely between insurers. And then we have seen the cost of cyber insurance kind of on the rise, just getting back to how complex these claims are getting, how big they're getting, and how more frequent they're showing up here.
Awesome. And to answer the question, a couple questions around like these units. So 1 million, what that represents is the amount of insurance that you're purchasing. That's different from the premium that you're actually paying. So the premium that you're paying, that the really annoying answer in insurance is always going to be, it depends, because your cost is really going to depend on so many factors. What's important to keep in mind is one of the biggest factors for how a coverage like cyber is priced is the amount of revenue. Right, bringing in. Is that the only factor? Definitely not. Also, we'll factor in the nature of your operations, technology that you're using, how much PII data you're collecting, what industry you operate in, et cetera, et cetera. So what we try to focus on from a benchmarking perspective, because it is so different for each company, is what is the biggest factor that goes into pricing, and how you should think about kind of the appropriate limits. So when I was mentioning before how in my days at E-Trade, right, we would require 5 million of cyber insurance for every company that we worked with, whether it was a vendor like Slack that the whole organization used, or it was a pre-seed startup that we were running a 6-week unpaid pilot for, right? So you can see that's a pretty high amount of insurance for a pre-seed or seed stage company, right? So you have to weigh the trade-off to say, you know, is the cost of the insurance program worth the cost of customer acquisition of that, you know, that company at the end of the day? And what we really encourage our customers to do is, you know, whether it's with Vouch or someone else, you know, work with an insurance provider to determine what is the necessary amount of insurance that I need at this point in time. Because if you can go into a company like an E-Trade or, you know, whoever and say, hey, no, you require 500, or sorry, that would be crazy, 5 million worth of, you know, cyber insurance. We actually worked with our insurance provider to determine that based on where we are as a business right now, 2 million in limits is actually more than sufficient. You might have they might say that this is what it is, take it or leave it, but they might be willing to negotiate, and you have more negotiation leverage if you've done the homework upfront to determine what's necessary for the business ahead of time.
Absolutely. And to that point, I guess a really nice call out with working with Vouch is we have crafted these really nice coverage benchmarking guides in conjunction with our underwriting team to kind of say, hey, this is what we think is an appropriate amount of coverage for a business your size. You can kind of see exactly how that scales up as your company grows. So really helps there too. I'm sure a lot of other carriers in the industry might have similar benchmarking guides. So to be able to have that knowledge and take it to your contract holder, they will sometimes lower those requirements or stand firm. So it's good to have that knowledge, like Ali mentioned.
Yeah, I like that you guys are bringing that up, because in the early days, especially with startups, in your first year or two, you will often get like, you're being scrappy. You don't necessarily have like the team that you want or the resources that you want. But especially if you're selling into or partnering with big organizations, I think Ali said it earlier, like sometimes they'll just shoot out boilerplate to you.
Mm-hmm.
And the negotiation is not like, can that be lower, please? Usually the negotiation needs to be backed up with like a reasoning or a rationale. So being proactive on that, especially if partnerships are a key part of your expansion strategy or even your go-to-market strategy, just allows you to negotiate from a position of more leverage. It's the same thing that we talk about with Gus Launch, being proactive 80% of the time about just the necessary stuff so that you can lead any kind of negotiation or any kind of conversation from a position of strength and knowledge, rather than like, oh, this is the first time I'm hearing about whatever insurance. Like I either blindly say what you suggest and pretend like I'm an expert too, or I naively respond like, do I really need this? Can it be less? There's definitely a better, more strategic approach that can really help tip the scales, when you are not super well resourced compared to your competitors, or when you're punching up because you're a startup.
Exactly. Right. So some key trends that we're seeing impacting cyber coverage. So mentioned this a little bit earlier, touched on it at least, that we are seeing rate increases from 20 to 50% typically in the market right now. It really just has to do with, again, the size of the attacks, the more frequent these attacks become, and then the complexity of these cyber attacks. So supply and demand issues as well here. So there is a limit in capacity. It's restricting tremendously. And then some carriers not writing new business either. We kind of mentioned before, this is a relatively new coverage. Tech moves pretty quickly. So insurance, being a more legacy kind of traditional type of business, typically tends to move a little bit slower. So we are seeing some of those legacy carriers either not write new business or be really careful about the risks that they do take on their books. And then again, that increase in ransomware attacks and payments, social engineering losses are up due to remote work as well there. So again, something designed to kind of be picked up by this cyber liability policy, but on the rise. So we're seeing increased rates there.
And I would just add, I don't think we mentioned this before, but when you think about risk mitigation, like as you're growing and scaling your team too, making sure that you're doing the right trainings, make sure your team knows what to look out for from a phishing perspective. Some of these attacks are so sophisticated now, it's pretty unreal. I'm sure we've all come close to falling victim to many of them. So the more kind of like training you can do with your team too, always helps.
Absolutely. Absolutely. All right. So why your cyber coverage's needs will change over time. So when a tech company first is starting out, cyber coverage needs may be relatively minimal. So the company may have like a basic website and limited amount of customer data to protect. So a lower coverage limit at that point may be sufficient. You might not yet have a product in market. You may not be storing any personal information or sensitive data. So it may not be that relevant at that point. Or you may be satisfied with a kind of a smaller coverage limit as well then. So as the company grows and expands its online presence, let's say, cyber coverage needs will likely increase. So the company may start collecting more sensitive customer data, such as payment information, personal identification data. That's, of course, going to require a higher coverage limit to protect against financial losses associated with the data breach. And then as the company becomes more established and well-known, it typically does and may become a more attractive target for cyber criminals as well. So success kind of two-sided there. It's great for you and your company, but now you kind of have a target on your back too there for cyber criminals. So the company may need to invest in a more robust cybersecurity measures at that time, like firewalls, intrusion detection systems. Again, as Ali mentioned, there's some more robust employee training programs to kind of help mitigate the risk of a cyber attack there. And then over the time, company cyber coverage needs will continue to evolve as new cyber threats emerge. The company's online presence and data protection requirements change. So it's important for your companies to regularly review your cyber insurance policies, and then of course work with an experienced insurance provider or legal team, even a cybersecurity team if you get to that certain stage in growth, to ensure that your coverage is up to date, adequate, and protecting against the financial losses associated with a potential cyber attack or breach.
Totally. And one thing I'll add that we see a lot of is particularly around a new fundraise that makes you very vulnerable. Once it's amazing when you, particularly in this fundraising environment, once you raise capital from investors, we see like those like weeks after a fundraising announcement is when you can be most susceptible to hacks and cyber crimes. Because people can see, you've got some new capital in your bank account, you're a little more well capitalized. So again, to Chris's point, it sometimes can put a little bit of a target on your back there.
Yeah, something to look out for. So getting into errors and omissions policy here. We typically hear this referred to as professional liability. So Vouch's errors and omissions, speaking for ourselves, is more specifically tech focused than a traditional professional liability policy. Just wanted to kind of throw that one in there as well. There are differences between some errors and omissions policy. So it does help to, of course, kind of look around and know exactly what you're getting into before you sign those policies, depending on the professional services that you're engaged in or the technology services that you're engaged in. So even the most careful and experienced tech companies can make mistakes or experience problems that lead to claims of negligence or errors. So this is really what this errors and omissions coverage is designed for. So if your products or services causes a financial loss to a client, there's potential that you're wrapped into a lawsuit here. So this is designed to kind of pick up those legal fees, fines, expenses that you may incur. It's worth mentioning that, and we'll touch on this, that data breaches and cyber attacks can also result in claims from negligence and errors. So oftentimes we do recommend that a company purchase the cyber insurance and the errors and omissions at the same time. This is why we at Vouch also kind of couple these coverages under our cyber, errors and omissions, and media liability policy. So we do recommend them kind of coming as a joint payer here. Typical instances we see when it comes to errors and omissions is like error in code. So it's designed to then step in and cover if a financial loss to a third party occurs because of your error in code there. Good example would be like an API operating software or financial services. Think of like wealth managers. There's a lot of risk there if there's some sort of error, even with their system. Maybe your system goes down for a little bit. You're offline for 2 days. Maybe your product launch is delayed. All instances like this could be picked up, could result in a lawsuit, and they're designed to be picked up by the errors and omissions coverage. So if it's mission critical to someone else, if your software is running at a music festival, your software is engaged in like medical diagnosis, this is really critical, and you're going to have a really high exposure to errors and omissions claims there. So tech companies especially face unique risks and liabilities that traditional liability insurance may not cover. So this is really designed to, again, protect your company in a situation where your services cause a financial loss to a client. Tech E&O is designed to cover those legal fees, the court costs, settlements, and judgments arising from claims of negligence, errors, in the provision of technology-related services. And then ultimately, this coverage is designed to help protect your business from those financial losses if you are to be wrapped into a lawsuit there because of this. It's an essential type of insurance for businesses that provide those technology-related services, especially once you get to the point where you have that product live in market. If you're raising a round or trying to secure a new contract, typically, again, a contractual requirement. If you've raised that new round, maybe you have that target on your back now, important there. Even if you're in the beta testing phase of things, again, depending on the size of your audience and where your product is reaching, it could be relevant in instances like that as well. So kind of goes back to like working with an experienced insurance provider, especially then what that offers a more tech-centric errors and omissions policy. If that's your niche, they're going to be able to help you ensure that your business has the right coverage to protect against these potential risks.
And Chris, interesting question from Winston in the chat. What tools do you guys use to quantify an insured's cyber exposure?
It's a great question. I actually might have to do a little bit more digging with our underwriting team. I've seen the reports. It's a little bit over my head, if I'm going to be honest with you, on kind of what some of that language means. Happy to kind of take that offline and get you more information on that side as well on what exactly we're using to test.
And one of the things I'll note, how we make recommendations for coverage. So when someone is getting a quote specifically, through Vouch, it's a digital application that's very dynamic in nature. So as you, answer questions about your business, all types of questions, right? What type of business you are, what your operations look like, how many people you have, capital that you've raised, are you collecting sensitive data? And then as you answer those questions, it's a dynamic application that you're being surfaced more questions that'll be more relevant. So all of that information is used by our underwriting algorithm, essentially to determine what your risk exposures are and what coverages are necessary. From a recommendation perspective. In some cases, for certain businesses, given some of the complexities, dynamics, sometimes our underwriting team will get involved as well to help us really assess, the risk exposures of a particular business. In some cases, we might need to have a deeper understanding of the company's operations and how they're serving customers and how they're collecting data, et cetera. So it really depends on the client, but there's a lot of information that we're looking at, and it's typically we collect as much as possible from kind of the digital application and that kind of self-serve experience, and then in some cases that we have to reach out manually for additional information as well.
Yeah, thanks so much, Allie.
Yeah.
Kind of touching on the claim side, we'll make this brief as well, but it's good to kind of call out that the average settlement in an errors and omissions lawsuit is more than 140,000, and that's not counting your legal costs. So gets back to those risk mitigation tactics there. If you're willing to accept that, it might be a little pricey to accept a risk like this, to just take something like this on. So it does typically make sense, especially if your product's live in market, if you're just launching, if you're raising a new round, to kind of transfer that risk to an insurance provider rather than accepting that on your own. Another really neat call out about Vouch's errors and omissions policy and special endorsement that we add, kind of getting here on the healthcare and IT startup side, is that we do extend some coverage for bodily harm through our errors and omissions products as well. So we have ancillary financial services endorsement or our digital health endorsement specifically for life sciences companies that can provide protection against the costs associated with harm caused by your product, including property damage or physical injury. So maybe you have a product in market that gives nurses the proper dosage that they're supposed to give a patient. Maybe there's an error in that code one day where your platform goes down that causes bodily harm to an individual. With our digital health endorsement, thankfully, we're able to extend that protection to the bodily injury resulting from that error or bug in your software. So some neat kind of call outs there as well. Really kind of just get back to why you should kind of touch base with your insurance provider to make sure you know exactly the ins and outs of your errors and omissions policy. Right. So this one, again, high variance of this. As Allie mentioned, we do have our Mad Lib application. So it depends on your business operations size, revenue, the personal information that you're collecting, the data that you're collecting or storing, kind of what that's looking like. Also does have a big impact on where your business is in this stage. So if you have a product already in market with a lot of active users or large contract holders, maybe with more lofty contract requirements there, may be more costly to acquire errors and omissions at that point. So really just at the end of the day, having proper risk management procedures in place, like quality control and assurance measures, coupled with like active testing and clear, strong contractual framework, defining project obligations, requirements, and timelines and deliverables. And then also clearly defining your scope of liability when working with a contract holder, are all things you could do to kind of help reduce your premium, or at the very least set your business up for better success. Awesome. So touching on some key trends here, we are seeing an increased demand. So as businesses increasingly rely on technology for their operations, the demand for technology-related services and products has grown. Typically results in increased demand for tech errors and omissions specifically, and then some higher premiums there as well. We're also seeing a lot of evolving risks. So the risks associated with technology-related services and products continue to evolve as new technologies emerge, as cyber threats become more sophisticated, results in insurers kind of updating their policies to extend and cover those risks. And we're also seeing some growing in regulatory scrutiny as well here. So regulators increasingly scrutinizing businesses' use of technology and data privacy practices. So this has resulted in new regulations and laws that businesses must comply with a lot of the times there, and then expanding coverage. So insurers are expanding their tech errors and omissions coverage offerings to cover new risks, emerging technologies, kind of going back to that life and health sciences. If there's potential for your product to cause bodily harm, even if it is a software company, instances like that being designed to be picked up. And then heightened cybersecurity awareness is another big factor here. The increasing frequency and severity of cyber attack claims, their businesses typically, hopefully, becoming a little bit more aware of the need for strong cybersecurity measures, and then these errors and omissions measures as well there. So it's continuing to grow, and we need to kind of just be aware of the changes and risks and coverage options available to ensure that you're properly protected. So why your errors and omission coverage needs will change over time. So let's say you're a technology startup founded and provide software development services to clients. So at the outset, the company may only need a basic errors and omissions policy to protect against claims of errors and omissions. As your company grows, you're going to need to get more contractual requirements, typically higher contractual requirements, which leads to an extensive errors and omissions policy as well there. And then ultimately, as your company begins providing professional services, maybe it's a mix of software, consulting, things like that. There may be a package where you're able to find errors and omissions specifically for the tech side, and then also those more traditional professional services as well. So I'm happy to kind of wrap it up at that point, since we're running close on time. But that's it.
All right, guys, I was trying to get a calendar link for you and I totally lost the slide. So Chris, thanks for being a total pro.
No.
But
sorry about that. That was my fault.
You guys are totally good.
No, I think you covered everything though, even without the slide guidance. So you're the best, Chris.
I appreciate it, guys.
I had an interesting question on the E&O before we move on.
Yeah.
I know you talked a lot about like lawsuit exposure and stuff like that, but does insurance apply in situations where maybe there's not a lawsuit? Like say you cause, an error in your software caused financial damage to a customer, and you as a company are like, oh, like that's on us, so we will like compensate, the customer for like whatever damage that we agree to without going to court. Is there still an insurance case in there, or does it always have to coincide with a lawsuit?
Yeah, I'm glad you kind of bring that up. Were you going to say something, Allie? I'm sorry, I kind of jumped in there. Okay, my apologies. I'm glad you bring it up though, Ryan, because it is just technically like a financial loss to your client. So I like to throw out the example of like a fintech company. If you're providing financial services to somebody, maybe it is just one individual client where, hey, your software goes down, or there's a bug and something's not produced properly there. You're not giving the correct guidance. So there are instances where maybe it is just kind of like a sole individual there. This is still kind of designed to kind of make them whole again, ultimately at the end of the day there. So if it's causing any sort of financial loss to your clients, designed to kind of pick those instances up as well. May not be a huge multi-million-dollar lawsuit, could be a smaller kind of claim there. Yeah,
just those are the kind of things I think of, because a lot of people kind of put in their head like insurance is for basically life or death situations, right? Oh no, like our entire thing failed on Super Bowl Sunday and we're a media company and like what are we going to do? Exactly. But there is cases for working with, a lot of providers. It's like, hey, if you've been paying for coverage and you're a startup and, the odds are stacked against you and like a thing happens, there's still, options rather than just like taking the L, completely.
Yeah, absolutely. Absolutely.
100%. And that's what it's all about, right? Like, again, there are going to be those like very high frequency and like lower severity incidents. And then there are going to be the like really low frequency, but high severity Super Bowl as incidents, right?
Yeah.
And so making sure that you just have a good sense of, how those things will occur and what you're covered for. So I know we just have a couple minutes. So just quickly, our job is to be here for you all as you're navigating the weird world of business insurance. At Vouch, again, we work specifically with high growth technology companies across the board. And so we have wonderful folks like Chris who spend all day, every day having conversations with folks like yourselves around, what your risk exposures look like, what your program should look like today, what it should look like tomorrow, what it should look like 6 months from now, et cetera. We offer all the coverages that we talked about today, and we have a lot of resources across the board. So I know, we're setting out some follow-ups. Ryan's going to share the recording as well. I share the milestones guide in the chat, which is a really good resource in terms of, how to think about what coverages your company needs across the board as you grow from like pre-seed through IPO. We do have a discount for us customers if you do go through and get a quote with Vouch or interest in securing coverages with us. And we're always happy to set up time to chat through your coverage as well. So, Ryan just put a link in the chat. Thank you. Thank you, Ryan. Tommy from our team, feel free to grab some time with him. He's happy to chat through your business, how you can think about pricing, how you can kind of plan for coverage, et cetera. Our goal is to make this stuff as painless as possible because you have a lot of other things to think about when you're running your business. So if we can kind of take this one thing off your plate and make it a little bit easier, we are thrilled to be able to do so. And thanks to Ryan and Gus for having us today. And thanks everyone for all of the questions as we've gone through as well. It makes the session so much more fun as we can answer questions and kind of get engagement throughout. So really appreciate everyone sticking with us.
And thank you, Allie, for really taking care of a lot of the questions kind of in situ as we were going through. Mark did ask, he can't click the links. Yes, because we're doing the screen share, but we will send this slide deck out with the follow-up resources. So you guys will have all these in a couple of days once we get the follow-ups out. And I believe Vouch will even reach out. If you've RSVP'd to this, you'll get the links. And I will say, as a somebody who's gone through for my own company to navigate through Vouch's experience and having been at Gus for more than a decade and done a lot of insurance stuff, it's very, very much our MO of like, take the 90% of the standard stuff, make it very software treatable, but then put a human in there at the right moment so that nobody's, blindly buying a policy and just hoping that it works out. The back and forth questions with Vouch are fantastic for actually understanding this and what coverage you actually need, because a lot of the other solutions in the space have been around for a huge long time. And it's just very obtuse when you're trying to, one, to know that you have the coverage that you want, and two, that you actually need it. So thank you, Vouch. I think we're like straight up to the moment. I think we got all the questions. Like I said, this is part 2. So part 3 will be coming up, and I'm completely blanking. Allie, do you remember the topic of part 3?
Raising capital.
There we go. Of course. At the
Everyone's
end of
favorite.
Exactly. Yeah. We'll see the RSVPs on those ones. But in a week from today, we will have one on raising capital. I think the invites will go out right now if they haven't already gone out. So check your email. That'll be from me, Nash at Gus. Sign up for that and we will tie this one up. And like I said, look forward in the summer, as we're probably going to experiment with some even cooler, more specific programming. Thank you for all your great questions. Chris, Allie, anything, any parting remarks?
Just thank you all so much for spending your afternoon with us talking about insurance, and excited to see some people already planning on joining us next week for when we talk raising capital. It should be fun.
Yeah,
excellent.
Absolutely. Thanks, Ryan and Gus. And
have a great rest of your week, everybody. We'll see you in a week.
Bye, guys.
Thanks, Ryan. Bye, everyone.